Northbound Wealth Management believes that true wealth management begins with disciplined, reasonable, holistic financial planning that over time results in experiencing financial freedom. Financial freedom is dreaming big, yet being specific about your goals. It is the freedom to make choices financially that you otherwise could not. Examples of financial freedom are choosing a career you love without worrying about money, retiring early, retiring on time, creating special experiences, funding education, and outrageous generosity. Northbound Wealth's purpose is to deliver intelligent, objective, and unbiased advice. Our portfolio management services and outcome-oriented strategies offer an exceptional experience. Northbound Wealth's framework as a registered investment advisor requires it to be a fiduciary for its clients. From the very beginning, we have held ourselves to the highest of standards to always act in our clients' best interests. Northbound Wealth Management was created by our founder and CEO, Brent Foster, in 2020 with a mission to serve people on their financial journey throughout life. For nearly 20 years, he's served clients across the country in this endeavor. Hello, everybody. This is Brent Foster, and this is the Northbound Wealth Podcast. Welcome to August 26, 2024. Here's your headline. Powell Fed is ready for the rate cut. So, stocks notched a solid gain as dovish comments from Federal Reserve officials boosted the market's recovery from early August lows. The S&P 500 rose 1.45%, while the Nasdaq Composite added 1.40%. The Dow Jones Industrial Average picked up 1.27%. The MSCI EAFE Index, which tracks developed overseas stock markets, gained 2.98%. So it was a dovish week last week. Stocks started the week strong, rallying after Wall Street welcomed dovish comments from Minneapolis Fed President Neil Kashkari. The S&P 500 and the Nasdaq each posted gains on Monday, the eighth consecutive winning session. The Dow rose for the fifth session in a row. From there, markets traded in a narrow band, while Wednesday afternoon, when Fed minutes released from the July 30th through 31st FOMC meeting revealed more dovish comments. On Thursday, stocks dipped ahead of Fed Chair Jerome Powell's annual Jackson Hole, Wyoming speech. Well-received comments from Powell on Friday boosted markets, with all three averages closing higher. So on my website, blog, Y-Charts, www.northboundwealth.com/blog, I've got major index returns summary. So the summary of these indexes. The Dow year to date is up 9.32%. The MSCI EAFE is up 10.60%. The Nasdaq's up 17.93%. The S&P 500 is up 17.84%. So all in all, doing quite well in the equity markets after the early August correction that we had. 10-year Treasury notes trading at 3.81. So yields are down from about 3 months ago, a print of 4.47, and 1 month ago, 4.25. Now we're trading at 3.81. So the interest rates are kind of already self-correcting a bit. Let's see. The time has come. It's been a long time, it seems. The Fed's annual symposium for global central bankers started Friday morning with Fed Chair Powell's much-anticipated speech. Citing the risk of the labor market cooling even further, he said, quote, "The time has come for policy to adjust," end quote. Which means interest rate cut at some point. Investors responded favorably, with the remaining question being how significant of a rate cut it might be. Powell kept the door open, adding that, quote, "The timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks," end quote. Fascinating. I'm on the edge of my seat with bated breath. Just kidding. All right. So this week, key economic data that we're tracking: Monday, durable goods, consumer confidence, Case-Shiller home price index, Fed official Raphael Bostic speaks on Wednesday. Thursday, GDP, international trading goods, jobless claims, pending home sales. Friday, personal income and outlays, consumer sentiment. So not bad. Pretty busy week. This week, notable companies reporting earnings. On Wednesday of this week is NVIDIA. So that's all the rave right now. Everyone's talking about it. Today is Monday. So Wednesday we'll be tracking that performance. And you've got Salesforce or CRM, the ticker symbol. That's also on Wednesday. Thursday, Dell Technologies. All right. Tax tip of the week. There are some essential tips to remember if you work as a gig worker, someone who takes temporary work through one or more employers. Bullet point number 1 is all income from these sources is taxable, regardless of whether you receive information returns. This includes both full-time and part-time work, and if you're paid in cash. Number 2, bullet point, is as a gig worker, you must be correctly classified as an employee or an independent contractor. This can depend on where you live, even for the same services. Lastly, it's important to remember to pay the correct amount of taxes on this income throughout the years to avoid owing when you file, because gig employees don't have an employer withholding taxes from their paychecks. They can either submit a new W-4 and have their employer withhold more from their paycheck. If they have another job as an employee, you can withhold more from that, or make quarterly estimated tax payments throughout the year. As a reminder, this information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax professional. And this tip was adapted from irs.gov. Stay tuned for the next segment. New data from the Bureau of Labor Statistics reveals a significant adjustment to our understanding of the job market. Here are key points. So 818,000 fewer jobs existed in March 2024 than initially reported. This marks the largest downward revision since 2009. The average monthly job gains from April 2023 to March of 24 were 173,500 versus the previously reported 242,000. While this revision is substantial, it's important to remember that job growth was still historically strong. This data gives us a more accurate picture of the labor market's health and could influence the Fed's decisions on interest rates. Don't hesitate to reach out if you have questions about how this might affect your financial goals and the stock market. Stay tuned for the next segment. This segment is called The Great Spending Balance. Love your life today while saving for tomorrow. So your financial life is a balancing act strung between living in the present and preparing for the future. Saving for retirement may be a focus, but it could feel like you're missing out living in the present. There are 3 key areas, however, where saving big and investing may make a substantial difference in both the present and future alike: your home, your vehicle, and your travel plans. In the following segment, we're going to explore some smart strategies to address with your financial professional if it's not Northbound Wealth Management, ensuring that you're able to enjoy your life in the present while still building a solid financial foundation for your future. Lifestyle choice number 1, your home. Our homes have become so much more than a place that we just live. They're where we gather with our loved ones and in some cases raise our own families as well. They've also become a symbolic reflection of the lifestyle we envision for ourselves. So it's a big deal. Where do you want to live, and how much house do you need? There are many factors that may impact your living situation, with location being the top one for most people. Living closer to work and as you get older to family may become important considerations. As you age, a larger home may yield a greater responsibility in terms of time, money, and maintenance. You may love the 3-story home you're in now, but later in life, climbing all those stairs could become a hassle. The long-term upkeep of a home could make it difficult to pursue your other retirement dreams. If you wanted to spend your golden years traveling, for example, you may want to consider discussing your home situation with your financial professional. For example, what type of mortgage should you choose? For many families, mortgages constitute a large portion of their overall liabilities. According to one report, mortgages represent 71% of all household debt. So it's important to evaluate your mortgage choices before selecting one that's appropriate for your financial situation. For example, the payments on a 30-year mortgage are generally lower than 15-year loans, but their interest rates tend to be higher. The lower payment comes from spreading out the loan over a longer period of time. Because of the time frame, a 30-year mortgage owner pays more in interest payments than a 15-year mortgage holder. So here's our case study, and this has to do with choosing whether to downsize. Let's follow this hypothetical couple, Ron and Tammy, as they review their home, their car, and their leisure choices in these following case studies. So here's the backstory. Ron and Tammy are both turning 55 and own a $500,000 house. Since their children no longer live at home, so they're empty nesters, they've decided to downsize and have $300,000 of home equity. Choices. Here they are. Here are the choices. They buy a $250,000 house with cash and plan to no longer have a mortgage payment. With $50,000 of home equity left over, they decide to invest it with a hypothetical 6% rate of return. Each month, they also place the money they save on a mortgage payment of $1,604 a month into the same investment. Here are the results of that situation. With a hypothetical 6% average annualized rate of return, their investment balance could grow to more than $900,000 over 20 years because of compounding interest, right? By downsizing, but continuing to invest their monthly payments, Ron and Tammy could significantly impact their net worth and future lifestyle. So again, that math is a $50,000 home equity plus the $1,604 per month and multiplied by the rate of return of 6% equals $900,000 over that 20-year period. And again, this is a hypothetical example used for illustrative purposes. Okay, so lifestyle choice number 2, your car. So some professionals suggest a guideline of paying up to 15% of your net income on car expenses. Obviously, it's best if you don't have any debt on cars. We can help you analyze your current debt budget and determine what type of payments would best fit your lifestyle. But here's the case study, buying a car. Ron and Tammy, as they decide which luxury car to buy. So there's 2 types of series of cars that they want. And of course, it's BMW, but they aren't sure whether to purchase a Series 7 or Series 5. So a Series 7 for $74,000 or a 5 Series for $56,000. So they decide to buy the 5 Series, which costs $18,000 less than the other model. Ron and Tammy could opt to invest the $18,000 they saved into an account with a hypothetical 6% rate of return. In addition, by selecting this model, the savings results from lower taxes, fuel costs, and insurance premiums could also be similarly invested. So here are the results of that choice. With their expected rate of return, Ron and Tammy's balance would reach $45,599 after 5 years. After 20 years, their account could be worth $109,281. By choosing the Series 5 or 5 Series, Ron and Tammy enjoy a luxury car while also potentially building their financial foundation for the future. Okay, let's take a look at lifestyle choice number 3. Moving on. Travel. While the nature of travel is in flux, you can still plan and budget for future trips. Many Americans go into debt to fund a vacation, but with few simple substitutions, you may be able to have some fun, have a memorable getaway without breaking the bank. So, if travel is a priority for you, listen up. It is for Ron and Tammy. Vacations are good for our mental health, yet they're likely a lower priority than a home or a car. With the right preparation, you should be able to continue to enjoy your time off while upholding your long-term goals. So, can you spend less and still enjoy yourself? You may be able to save on your vacations by doing some of the following tips, right? So, scheduling weekend flights to save on airfare, traveling during the off-season, using discount sites for car rentals, renting a privately owned home instead of booking a room at a luxury hotel, investing in vacation home ownership to share the cost with others. By strategically approaching your travel choices, you can still have the lifestyle you enjoy while potentially building your retirement investments. So here's our case study, traveling economically. Let's take a look at how Ron and Tammy decide to spend their leisure time. Here's their backstory on this. Every year, Tammy and Ron take a 2-week vacation. They've traditionally stayed at expensive hotels to enhance their lifestyles. Now they want to rethink their leisure options and see if they can have a similar experience at a reduced cost. So their choice is they replace their $400 nightly hotel fee with a privately owned condo, which is half the expense. With a condo, they can also prepare some meals and cut down some food costs. In addition, they'll watch for deals on flights and use airline miles, potentially reducing what they've paid in travel. Here's the result of that. Switching from a hotel to a condo could save Ron and Tammy $2,800 per year. And with less pricey meals and flights, they lower their expenses by another, let's say, $2,000, reducing their total costs by $4,800 for their annual trips. They decide to invest the $4,800 savings and anticipate earning a hypothetical 6% rate of return. Going forward, they plan to deposit $4,800 into the same investment each year for 20 years, for the next 20 years, obviously. By the end of those 2 decades, the account could have a balance of more than $175,000 without needing to sacrifice their annual 2-week vacation. So they actually could take additional trips down the road if they save early and often and get a hypothetical 6% annualized rate of return. So find your balance in life. So Ron and Tammy were able to balance the kind of life they want to live while saving and investing for the future. They enjoyed a mortgage-free home, BMW, and annual 2-week vacations, all while saving a projected $1.184 million after 20 years. Each financial decision can be a complex mix of wants and needs. As you work with your financial professional to build your investments, understand that the things that you care about and value, can fit both your lifestyle priorities and your long-term goals. Again, as a disclosure, this is a hypothetical example used for illustrative purposes and is not representative of any specific investment or combination of investments. And it's a lot of the sources of this information was derived from the New York Fed, money.com, thebalance.com, CNBC, moneyunder30.com, CN Traveler, travelandleisure.com, and Forbes.com. Thanks for listening and stay tuned for the next segment. Hello, everyone. My name is Brent Foster, and I've been in the financial services industry for nearly 20 years in various capacities. I value direct communication, the truth, integrity, and the commitment to learning and growing towards being the best advisor, RIA firm, and person that I could be, which affects my clients' experience and outcomes. I came from nothing, I can take nothing with me, so I plan on making this the best journey possible. Finally, I like to have fun while working hard, because life is too short otherwise. Go to www.northboundwealth.com and check us out. Reach out to us. We'd be delighted to have a conversation with you. Testing, 1, 2, testing, 1, 2. Here are 7 principles of long-term investing. Hiding your money. Testing, 1, 2. Here are 7 principles of long-term investing. Hiding your money under a mattress as an investment strategy is probably not a good idea. You put your money at all sorts of risks: fire, floods, forgetfulness. Therefore, one of the first places thieves may go to look for your stash is under your mattress. Despite these potential issues, a recent AARP survey revealed that millions of Americans aged 55 and over simply stash sums of cash at home. Keeping a small amount of cash around the house might be a good idea for emergencies, but in the long run, the idle cash under the mattress choice represents a role money should not play in your life. Since money is obviously transactional in nature, it should be producing something for you. After all, you worked for it. It should return the favor. Our marketplace economy, in America especially, provides ample opportunities for your money, and hiding it under the mattress is certainly not one of them. So, what choices do you have to get money to roll up its sleeves and get some heavy lifting on your behalf? The short answer is investing. Frankly, in this higher interest rate environment we've experienced over the last couple of years, money markets and some exchange traded funds that trade in treasuries or T bills and treasury notes, even on the short term, within 1 or 2 years, are paying right now, even with the lowering of interest rates between 4.5% and 5.5%. So is your savings account sitting at the bank producing that? If not, you need to really look hard at it. So, looking at today, investing enables us to put fruits of our labors to work. It allows us the potential to build wealth for the future and possibly for retirement. But despite the opportunities to invest and create savings for later years, 1/3 of American workers have less than $50,000 in savings and investments. It's pretty scary when you really think about it. Here are two interesting facts about inflation and investing. So, inflation, which is basically a killer for money, okay? Inflation, an overall rise in the cost of goods and services. It really started trending higher in 2021 and really has peaked out recently. And inflation's been tough. It started to trend back down a bit because the federal government raised interest rates. But generally speaking, since 1982, inflation's usually around 3%, ballpark. That's an estimate. But looking at some of the data, that's kind of like the ballpark. So what's next for inflation is unclear. We know it's trending down, and the Fed has a 2% target for that. We don't know if they'll get there, but if they end up getting inflation down to 3, that's in line with data going back to 1982. But today's higher prices are reminding us of some of the high inflation years of the 1970s. With an inflation rate of 3%, an income of $50,000 today would have just over $32,000 in purchasing power 15 years later. That's a 35% decline. Said differently, to maintain the lifestyle you enjoy on a $50,000 per year income today, you would need about $77,900 of income after 15 years of 3% inflation. This is a hypothetical example, right? Used for illustrative purposes only. So, the decision to invest is also an acknowledgement that investing comes with certain risks. Not all investments will do well, and some may lose money. However, without risk, there would be no opportunity to earn the higher returns that may help you grow your wealth. To manage investment risk, consider maintaining a broad diversification of your investments that reflects your personal risk tolerance, time horizon, and financial goals. And remember that diversification is an approach that helps manage investment risk. It does not eliminate the risk of loss if security prices decline. So, take advantage of the financial market's potential. Investing provides you the opportunity to pursue your financial goals and shape your own future. Here are 7 principles, okay? Number 1, allocate your assets. Using asset allocation, investors divide their money among different asset classes such as stocks, bonds, and cash alternatives like money market accounts. These asset classes have different risk profiles and potential returns. One that I will mention is real estate is another asset class, obviously, like hard assets out there. The idea behind asset allocation is to offset losses in one class with gains in another and thus reduce the overall risk of the portfolio. It's important to remember that asset allocation is an approach to help manage investment risk. It does not guarantee against investment loss, okay? The most appropriate asset allocation will depend on the individual situation. Among other considerations, it may be determined by 2 broad factors. Number 1, time, and number 2, risk tolerance. So, investors with longer time frames may be comfortable with investments that offer higher potential returns but also higher risk. A longer time frame may allow individuals to ride out the market's ups and downs. An investor with a shorter time frame may need to consider market volatility when evaluating various investment choices. That second bullet point is risk tolerance, okay? So, an investor with a high risk tolerance may be more willing to accept greater market volatility in the pursuit of potential returns. An investor with a low risk tolerance may be willing to forego some potential returns in favor of investments that attempt to limit price swings, okay? Number 2, take advantage of opportunities. Many investors make long-term investment decisions with one target in mind: building for retirement. One approach to long-term investing is taking advantage of employer-sponsored plans. Their deferment of federal taxes reduces employees' immediate annual taxable income. Some employers also make matching contributions to employer-sponsored plans. Employer contributions may be considered an incentive to enroll in an employer-sponsored plan. In most circumstances, you must begin taking required minimum distributions from your 401k or other defined contribution plan in the year that you turn 73. Withdrawals from your 401k or other defined contribution plans are taxed as ordinary income, and if taken before the age of 59 and a half, may be subject to a 10% federal income tax penalty. So what that means is you shouldn't really tap into those retirement assets until the age of 59 and a half. So you really have to think hard and long about how much you're contributing to those tax-deferred, longer-term investment vehicles. I think they're advantageous for the majority of people, but not all the time. So talk about that with your financial professional. Number 3, take appropriate risk. So that's a big question. What is appropriate risk? You got to talk to somebody about that if you don't understand where you're at on the spectrum. But while risk is inevitable and integral to investing, one of the most important questions you should ask yourself is, how much risk are you willing to accept? If you're in your 20s, you may have at least 4 decades before you decide to retire. At that age, you may consider pursuing higher risk investments that can weather long-term market fluctuations. However, if you're in your 60s and retirement is clearly within sight, you may want to create a portfolio that has a lower risk profile. Number 4, make regular contributions. One way to potentially build wealth over the long haul is through consistent investing. However, as with any long-term pursuit, investing requires consistency and discipline. By developing the habit of making regular deposits, your investments may grow over time. Obviously, you would need to budget in order to do that effectively. Automatic investments allow you to do dollar cost averaging, which is a way of purchasing investments over time. When prices are low, more shares are acquired. When prices are high, fewer shares are bought. Keep in mind that dollar cost averaging does not protect against a loss in a declining market or guarantee a profit in a rising market. Dollar cost averaging is the process of investing a fixed amount of money in an investment vehicle at regular intervals, typically monthly, for an extended period of time, regardless of price. Investors should evaluate their financial ability to continue making purchases through periods of declining and rising prices. The return and principal value of stock prices will fluctuate as the market conditions change, and shares, when sold, may be worth more or less than their original cost. Number 5, understand what you own. You probably would not buy a car without understanding at least the basics about the make, the model, and how it performs. Buyers often test drive vehicles to determine whether or not they're good fits, and many conduct further research before making decisions to buy. The same principle applies to other areas of life, such as healthcare and buying a home. Investing should be no different. You should consider having at least a basic understanding of the business in which you want to invest. Experts say that a good understanding of the businesses you choose may help you distinguish between the investment and noise and a meaningful. Experts say that a good understanding of the businesses you choose may help you distinguish between the investment noise and meaningful information that can truly help shape your decision making. Still, understanding the basic components of your investments may help you feel more confident in your long-term approach. Doing your homework may help alleviate confusion and offset possibilities and missteps later. I'd like to share with you a quote by Warren Buffett. Only buy something that you'd perfectly be happy with holding if the market shut down for 10 years. Think about that for a minute. Number 6, consider starting early. You may have come across the mathematical justifications for investing early and often. Consider this one. You're 25 and invest $300 a month for the following 10 years. You generate a hypothetical 6% return on your investments. When you're 35, you'll have $50,298. Let's up your monthly contribution to $600 for the next decade. You'll have $190,672. Let's add another $600 per month, which is $1,200 total to your investment savings for another 10 years. At 55, you'll have around $542,656. Now, let's bump it up to $2,000 a month for another 10 years. And by the time you reach 65, you'll have more than $1.3 million. The benefits of investing early become more apparent when you compare, in another example, the earnings of two people, both age 20. The investment is generating a hypothetical 7% annual rate of return. Eric Early invests $100 a month until he turns 30. He doesn't contribute any more to his account until he reaches the age of 60. Linda later begins investing in her account when she's 30. She puts in $100 a month for 30 years until she retires at the age of 60. Eric Early started early and invested a total of $12,000. Linda later started later and invested a total of $36,000. At age 60, Eric has $135,000 and Linda has $121,000. If, however, Eric Early continued investing $100 a month at the hypothetical 7% rate until he turned 60, he would have $256,332. The lesson is simple. Start investing early and keep it up once you start investing early. And again, as a reminder, this is a hypothetical example. It's not representative of any specific situation. Your results may vary, and the rates of return used in this hypothetical do not reflect the deduction of fees and charges inherent to investing. Number 7, manage your emotions. Probably one of the behavioral finance, one of the biggest ones. Conventional wisdom warns against processing your investment decisions through an emotional filter. Well, that's good advice. It needs some elaboration. Making emotional investment decisions, whether from exuberance or panic, has the potential to set the stage for disaster or, in the absolute best case scenario, missed opportunities. The market's occasional tumbles have sent many emotional investors into a panic and quick exits. The takeaway, it's often better to hang on for the ride than to jump ship based on emotional reactions to noise from the media. While detaching ourselves from our emotional or behavioral inclinations may be challenging, we can at least put them in the proper context. This may give us the opportunity to prevent our emotions from shaping our biases and, worse, influencing our decisions. Emotional biases may include overconfidence, lack of confidence, fear of risk, overreacting to the latest investment news, following the latest trends, reacting by instinct or gut feeling, investing based on personal attachment, overreacting based on past experience, and ironically, stoically ignoring the emotions related to investing. Responsible, clear-headed investing and steady monitoring of the markets may help you pursue your long-term investment goals. In conclusion, we hope that you found this segment educational and informative. You may incorporate the principles in this segment into your retirement strategy to help you pursue your investment goals. And of course, working with a financial professional may help equip you to find the solutions that may fit your retirement lifestyle. Thank you for listening. I appreciate your attendance, and follow, like, and subscribe. and enjoy the rest of this week, the final weeks of summer here as we head into the beginning of September. And have a great long Labor Day weekend. Signing off, Brent Foster, the Northbound Wealth Podcast. Thank you. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, and tax advice or as a solicitation to offer or buy any securities. Clients of Northbound Wealth Management may maintain positions in the securities discussed in this podcast.